Good day, everyone. Today we are going to discuss about notes to financial statements. And we are the group 5. Notes to financial statements provide narrative description or disaggregation of items presented in the financial statements and information about items that do not qualify for recognition. Notes contain information in addition to that presented in the statement of financial position, income statement, statement of comprehensive income, statement of changes in equity, and statement of cash flow. In other words, notes to financial statements are used to report information that does not fit into the body of the financial statements. In order to enhance the understandability of the financial statements, the notes to financial statements, sometimes called footnotes, are also an integral part of the overall picture. If the income statements, balance sheet, and statement of cash flow are the heart of the financial statements, then the footnotes are the arteries that keep everything connected. The notes will list relevant things like outstanding leases, the maturity dates of outstanding debt, and even details on where the revenue actually came from. Generally speaking, there are two types of footnotes: the accounting methods and disclosure. Accounting methods. This type of footnote identifies and explains the major accounting policies of the business. This portion of the footnotes will tell you the nature of the company's business, when its fiscal year starts and ends, how inventory costs are determined, and any other significant accounting policies that the company feels that you should be aware of. This is especially important if a company has changed accounting policies. It may be that a firm is practicing cookie jar accounting and is changing policies only to take advantage of current conditions to hide poor performance. Disclosure. The second type of footnote provides additional disclosure that simply could not be put in the financial statements. The financial statements in an annual report are supposed to be clean and easy to follow. To maintain this cleanliness, other calculations are left for the footnotes. For example, details of long-term debt such as maturity dates and the interest rates at which debt was issued can give you a better idea of how borrowing costs are laid out. Other areas of disclosure include everything from pension plan liabilities for existing employees to details about ominous legal proceedings the company is involved in. So just always remember that notes to financial statements are a component of a company's annual report or annual financial statements. They provide additional information and explanations about various items in the financial statements, helping readers better understand the company's financial position and performance. The notes can include details about accounting policies, specific transactions, contingent liabilities, significant events, and other relevant information.
Types of footnotes to the financial statements. Footnotes may provide additional information used to clarify various points. This can include further details about items used as a reference, clarification of any applicable policies, a variety of required disclosures, or adjustments made to certain figures. While much of the information may be considered required in nature, providing all the information within the body of the statement may overwhelm the document, making it more difficult to read and interpret by those who receive them. So there are several types of footnotes that can be found in the financial statements. One common type is the accounting policy footnote, which provide information about the specific accounting methods and principles used by the company. Another type is the contingent liabilities footnote. which discloses potential liabilities that may arise in the future. Additionally, there are footnotes for related party transactions, leases, and significant events or transactions that occurred during the reporting period.
So next is, let's talk about accounting policies. Accounting policies are defined as the specific principles, methods, practices, rules, bases, and inventions adopted by the entity in preparing and presenting financial statements. Accounting standards set out the required recognition and measurement principles that an entity shall follow in preparing its financial statements and shall often prescribe the accounting policy to be adopted. So, for example, for accounting policy is inventory. When you value or when you record your inventory, you use the FIFO method or say so for example average method. So whatever the principles of practice or rules or shall I say accounting policy for inventory that must be disclosed in the notes of financial statements method of depreciation. If you use straight line, double declining, or some of your teach it in computing the depreciation, that should disclose in the notes to financial states and any other accounting policies.
Compliance with PRFS. PAS 1 paragraph 16 provides that entity whose financial statements comply with Philippine financial reporting standards shall make explicit and unserved statement of such compliance in the notes. An entity shall not describe financial statement complying with PFS unless they comply with all the requirements of each applicable Philippine financial reporting standard. So what is the meaning of PFRS? PFRS stands for Philippine Financial Reporting Standards. So, the financial statements have been prepared in accordance with the Philippine Financial Reporting Standards issued by the Philippine Financial Standards Reporting Council. The accounting policies adopted in the preparation of the financial statements have been applied on a consistent basis. So, this PAS 1 or the PAS 1, this requires that an entity whose financial statements comply with PFRS make an explicit and unserved statement of such compliance in the notes. So, as it says there that financial statements shall not be described as complying with PFRS unless they comply with all the requirements of the PFRH, which is the Philippine Financial Reporting Standards. So, the ability to continue as a going concern each time financial statements should be prepared or are prepared.
Importance of notes to financial statements. Notes, also known as footnotes, are important in accounting because they provide additional information regarding methodology, valuation, time period, and myriad. Financial statements and reports provide a uniform framework for evaluating sales, net income, cash flow, assets, liabilities, and stockholder equity. There are many different ways these accounts can be interpreted and valued based on both the business and industry. Notes provide an explanation for how the numbers in the financial statement or report are calculated. So these financial statement notes are the supplemental notes that are included with the published financial statements of a company. The notes are used to explain the assumptions used to prepare the number in the financial statements, as well as the accounting policies adopted by the company. The notes will also include information that explains how estimated valuations were found and the expected impact of future liabilities on the financial status of the organization.
Purpose of notes to financial statements. The purpose of notes to the financial statement is to provide a necessary disclosure required by the Philippine Financial Report Standards. Specifically, PAS 1, Presentation of Financial Statement, paragraph 112 provides that the notes to the financial statement shall A. Present information about the basis of preparation of the financial statement and the specific accounting policies used. This involves explaining how a company has prepared its financial statements, which could be based on a specific set of accounting principles. It also includes disclosing the specific accounting policies the company has adopted, such as how it values assets and liabilities, recognizes revenue, and deals with expenses. B. Disclose the information required by the Philippine Financial Reporting Standard that is not presented in the financial statements. This point emphasizes the importance of disclosing any additional information or data that is mandated by the Philippine Financial Reporting Standards, but is not included in the core financial statement themselves. For instance, PFRS might require certain notes, explanation, or supplementary schedule to provide a more comprehensive understanding of the financial position and performance of the company. C. Provide additional information which is not presented in the financial statement but is relevant to an understanding of the financial statements.
Standards provide that an entity shall disclose in a summary of significant accounting policies the judgment of management has made in the process of applying accounting policies that have a significant effect on the amounts recognized in the financial statements. Specifically, management makes judgments in determining the following: whether financial assets are to be measured at a fair value or at amortized cost, whether substantially all the significant risks and rewards of ownership of the leased assets are transferred to the lease, whether in substance particular sales of goods or products financing arrangements and therefore do not give rise to revenue.